Section 17. Fundamentals of Cancellation of Debt. A few days after the lender approved Tom and Emily's short sale, Mark received another phone call. "Mark," Tom said, "our lender approved the sale, but my brother keeps telling me we're going to get a huge tax bill because the bank is forgiving part of our mortgage." Mark paused before answering. "I know enough not to guess. I'd rather make sure I give you accurate information." After the call, Mark walked into Lisa's office. "I think I understand the short sale process pretty well now," he said, "but I'm still nervous whenever clients ask tax questions." Lisa smiled. "Good. You should be. Taxes are one area where Arizona real estate professionals must be especially careful." She pulled out the lender's approval letter. Sometimes a lender agrees to accept less than the amount owed on the loan. When that happens, people often hear the phrase cancellation of debt, sometimes called COD income. So what does that actually mean? Lisa explained that when a lender forgives part of a borrower's debt, federal tax law may treat the forgiven amount as taxable income unless an exception or exclusion applies. She wrote a simple example on the whiteboard. Mortgage balance, $350,000. Short sale price, $300,000. Debt forgiven, $50,000. In this example, Lisa explained, the lender accepted $300,000 instead of the full $350,000 owed. The question then becomes whether the forgiven $50,000 has tax consequences. Mark immediately asked, "So every homeowner has to pay taxes on the forgiven amount?" Lisa smiled. "That's another common misconception. The answer is not necessarily." She explained that federal tax laws have changed several times over the years, and the availability of exclusions or exemptions depends on the homeowner's individual circumstances and the tax laws in effect when the debt is forgiven. For example, Lisa continued, certain taxpayers may qualify for exclusions based on insolvency, bankruptcy, or other provisions of the Internal Revenue Code. Congress has also enacted temporary legislation at various times affecting the tax treatment of forgiven mortgage debt. She paused before making an important point. "That's exactly why we don't tell clients whether they'll owe taxes." Mark smiled. "We tell them to speak with a tax professional." Exactly. Lisa explained that lenders frequently issue IRS Form 1099-C, cancellation of debt, when debt has been forgiven. Receiving a 1099-C doesn't automatically mean taxes are owed. It simply means the lender has reported the canceled debt to the IRS. The homeowner's tax professional will determine how that debt should be treated under current tax law. Mark nodded. "So receiving the form is only part of the process?" "Correct. One of the biggest mistakes a real estate professional can make is telling a seller, 'Don't worry, you won't owe taxes.'" She shook her head. "We simply don't know. Every taxpayer's financial situation is different. Tax laws change, and every short sale has unique facts." She reminded Mark that one homeowner may qualify for an exclusion, while another homeowner in a nearly identical transaction may not. That's why professional tax advice is so important. Mark looked back at Tom's file. "So when should we bring up the tax issue?" Lisa smiled. "As early as possible." She explained that sellers should understand the potential tax implications before deciding to proceed with a short sale, not after the transaction has already closed. The goal isn't to scare people. The goal is to make sure there are no surprises. She also reminded Mark that tax consequences are only one part of the overall financial picture. Homeowners should also consider possible deficiency liability, future borrowing ability, credit reporting, overall financial recovery. A short sale may still be the best option, Lisa explained, but homeowners deserve to understand the complete picture before making that decision. Mark closed his notebook. "I've noticed something. Every section of this course comes back to the same idea." Lisa smiled. "Which is? Protect the public, educate your clients, and know when to involve other professionals." Lisa nodded. "That's exactly what Arizona real estate professionals are expected to do." She gathered the file. "Now that we've discussed the possible financial and tax implications of a short sale, let's turn our attention to another important responsibility. We'll look at the ethical and licensing obligations real estate professionals must follow when representing clients in short sale transactions. Key takeaways. Cancellation of debt, COD, may occur when a lender forgives part of a mortgage balance in a short sale. Forgiven debt may have federal tax consequences depending on the homeowner's circumstances and current tax law. Lenders commonly issue IRS Form 1099-C when debt has been canceled. Arizona real estate professionals should never provide tax advice or guarantee a particular tax outcome. Sellers should be encouraged to consult a qualified tax professional before completing a short sale. Online discussion. Question 1. Why should real estate professionals avoid telling sellers whether they will owe taxes after a short sale? Answer. Tax consequences depend on current federal tax law and each taxpayer's individual financial circumstances. Determining tax liability is outside the scope of a real estate license and should be handled by a qualified tax professional. Question 2. What is IRS Form 1099-C and why is it important? Answer. Form 1099-C reports canceled debt to the IRS. Receiving the form does not automatically mean taxes are owed, but it alerts the taxpayer and their tax professional that canceled debt may need to be addressed on the tax return. Question 3. Why is it important to discuss possible tax implications before a short sale closes? Answer. Early discussions allow homeowners to seek professional tax advice, understand potential consequences, and make informed decisions before completing the transaction.